Our next discussion is going to focus on financing investment on the continent and will be facilitated by Mark Richards, who is a non-executive director and chairman of the Risk Committee at CIB Bank in Egypt. So please welcome our next set of speakers.
Thank you. In the next half hour or so, we're going to look at the private sector view of investment and the experiences of a great set of investors across the continent. I think between the panelists, we touch all corners of Africa. Between the firms involved, they have mobilized collectively more than $10 billion of private sector investment. So this is the private sector view of the questions of this morning. And our goal is to look at the operating environment from the day-to-day investors' point of view. So I'm going to start by just asking everybody to talk about their own experience of investing in Africa, what investors are saying, and how free trade might make a difference to them. If I may, I'll start with Sully, and I'll ask each panelist to introduce themselves as they go. To start, so Sully, over to you.
Thank you, Mark. So maybe I'll just a quick introduction about Helios. So Helios Investment Partners is today the largest private equity firm that invests exclusively in Africa. We manage a bit more than $3.5 billion, and we have investments in more than 30 countries. What's our strategy? Our approach is to really create or back market leaders that operate in key sectors in Africa, in sectors in the economy, and in key countries in Africa. Now, how do we do it? Maybe I can just pick an example. One of our investors I'll take maybe is a company called Equity Bank. Equity Bank was a bank we invested in 2007, and it was Kenya in Kenya. So Kenya is a market that has 48 banks. And we made the investment in Equity Bank. The thesis was that you had a platform that could really serve the informal sector. They were not catering to the mass, to the top of the pyramid, but really to the farmer and the informal sector. And they were only operating in Kenya. So our approach was to really back the entrepreneur to expand that model across a number of countries in Africa. And what's interesting about that model was that by providing capital and helping them expand new geographies, they went from being among the 48 banks in Kenya having 6% market share to having more than half of all the bank accounts in the country. More importantly was actually the way they grew was not by signing up people who had already bank accounts, but by finding people who already were not covered by the traditional banking sector. And more importantly is actually when you look at their performance, they managed to do so by becoming the third most profitable bank in the world in terms of return on equity and return on capital over a 10-year period. So this is a kind of example that kind of highlights how by backing entrepreneurs, the right business model, helping them expand across the region, you can really create a business that has a big impact in our markets, but also deliver good returns. Now, how does trade impact? How should we think about trade as a PE investor? I think as an investor, there are a number of levels. First one, I would say that one challenge you have today, even if you have this free trade agreement, is you don't really have one country. You don't have one, most countries don't operate as a single unit. We look at, I'm from Senegal. If you look at from the north of the country to the south of the country, you have many products that are produced in one side of the country that never make it to the markets. So till you actually have a functioning market in your own country, even if you open the borders, you're going to have challenges. If you look at, for example, the importation of fertilizer in Cameroon at the port of Douala, the price between Douala and the Baltic is a difference of 10%, but between Douala to the north of the country, it's a factor of 3. Once again, before you even think about going from Cameroon to Chad, solve Cameroon itself. That's one. Now, the trade could be a big opportunity because it allows scale. So when you look at banking sector, many sectors, economy of scale is really important. And through trade, you can create clusters of scale that can really compete and also lower the overall cost structure. Because quite often our markets are very small. So as a PE investor, I like regional platforms, creating Pan-African platforms because you can get talent, you have scale, and it has many benefits. But there's a lot to be done inside our own countries first.
Absolutely. And if I may, Archie Babacar, build on those themes. Each of our regions in the continent have very different challenges. Can you share some of your experiences in that regard?
Yeah, sure. Thanks. Maybe I'll start by introducing DPI very quickly. So DPI is very similar to Helios. We focus on Africa. Today we manage $1.1 billion and we present in over 30 countries. Our investment strategy is around backing entrepreneurs that focuses on the emerging middle class. So in terms of sectors, we invest in education, health, FMCG, financial services, and how we do it is we want to create champions. So we back African entrepreneurs in one country, and typically what happens is we help them develop in 5, 6, 7 countries, either as in a Pan-African setting, or in their regions. As for myself, from Senegal, so Senegal is overrepresented in this panel today. For some reason, I don't know, but from Senegal, born and raised in Senegal, educated in the US and UK, and I'm very glad to be here today as an alum and to see many familiar faces. Coming back to your question, I think so. Trade is critical for us because one thing that we really value as an investor is scale. How do you scale? As Suleiman mentioned, a lot of these countries are very small. To grow these companies, to make them successful, you need bigger markets. And a good example of that, I think personally that some of these markets are more interlinked than we think. There's been challenges in country, as Suleiman mentioned, so it's difficult sometimes to trade within one country. But what typically happens is that if you take the case of Francophone Africa, for example, thanks to the French, they've done a lot of things before the independence to integrate that region in order to trade better. But what it did is that it created we have a common FX, common law. It's highly integrated as an economy, so it's very easy to trade from Senegal to Mali to Togo and Gambia and all these countries.
And just building on that point for a second, do you believe that free trade area really has facilitated trade? For those who are talking about the continent-wide free trade agreement, the case study of what has gone on in Francophone West Africa is an interesting one.
Yeah, no, it has facilitated trade. I mean, today, one of our strategies is to invest in multi-country companies. So, for example, we invested in a bank in Côte d'Ivoire, and that bank was set up in the late 90s. And within literally 6 years, they've been able to operate in 8 countries. Now, for Africa, I think that's quite an achievement. And that would not have been possible if the central bank wasn't the same, if the currency would not be the same. So it was very easy to scale up because of links that already exist. Now, in terms of challenges, there are challenges, as Suleiman mentioned. So we see a lot of challenges in terms of logistics, in terms of regulation, but there are ways, and we believe that's where knowing the continent, knowing how to operate in the continent comes very handy. There are ways to go around those issues, and I'll elaborate on some of them later on.
Thank you. Guido, it's often said of the private equity industry, there's plenty of money these days, there's too much dry powder in the industry. But I'd like you to talk a little bit about more than money, impact. Is that an important part of the private sector? We were hearing earlier in the conversation the relationship between government and the private sector. And we're also talking about the social aspects of building society. Can you share your experiences both facilitating capital movement, but also people skills, and how integrated are they as part of your investment thesis?
I'll start by saying I was here as a student like Babakar, but over 10 years ago, and after doing an MBA, I did a research degree on private equity as an instrument of development in Africa, because private equity has been used as an instrument of development in Africa for over 50 years. And our industry would not exist without the development finance institutions investing and continuing to invest in our industry. So that point of private sector development and using capital as a force for unlocking the positive benefits of entrepreneurship has been probably best proven on our continent compared to many other regions. So building upon that, I think a key thing to perhaps dive into is some of the sectors, and healthcare is a good example. Education is another good example, where you definitely need that interplay between the government and the private sector. Primary education, primary healthcare does not make sense for the private sector to provide, not at the price point that people are able and willing to provide. And without having that streaming effect, you can build secondary care hospitals, you can build tertiary care hospitals, but if you still have only those who can afford to come and pay to get their scrapes, their aches, and their bruises, you're going to end up in a situation which we have currently today, where we have an increase in terms of non-communicable diseases on the continent, which is lifestyle in nature for the most part, and requires a very different cost structure in terms of how you're going to be able to provide the care. So when we talk about impact, and when we talk about private equity, and when we talk about entrepreneurship, on the continent, these three go hand in hand.
Absolutely. And continuing the sector theme, Berhane, you represent one of the most exciting economies in Africa at the moment, Ethiopia, with a growing manufacturing sector. And often when we talk about free trade agreements, it's manufacturing, agriculture, which are at the heart of those debates. So as you think as an investor in Ethiopia, is it the domestic market that's your focus today? And will free trade agreements change anything in your perspective and how you invest?
Okay, I'll introduce myself first. I'm Berhane Dempsey, co-founder and managing partner at CFIUS. CFIUS is primarily focused on investing in Ethiopia, but it also has some allocation for regional integration as well, which will play later on with the Africa Free Trade Agreement. We like investing in manufacturing, agro-processing, and services, which includes healthcare and education. And mostly, even though our primary focus is Ethiopia, is because we believe our competitive advantage isn't really the knowledge of the country, rather than knowledge of the whole Pan-Africa. So in our strategy, like you said, we focus on industrialization, which really helps into moving into that free trade agreement. And we believe that what is our competitive advantage within the country to be able to add value and service the huge domestic market that we have. Ethiopia is the second largest country in terms of population in Africa at 106 million. So we have a huge domestic market that is underserved with goods and services that are currently being met through imports. And so that creates a huge opportunity for us for the domestic market. So like Suleiman said earlier on, we're focusing first on our home market, trying to service our home market, and also trying to see how we can integrate regionally with neighboring countries before developing into the Pan-African strategy.
Yeah. I mean, I think one thing I would just personally add, the scale of the African continent, everybody in this room knows very well. It's America, it's India, it's China, and put together in geographic terms. And physically moving goods across that sort of distance with this sort of infrastructure that's out there is as big a factor as any free trade agreement is ever going to be. So it is not surprising, I think, our panelists are all focusing first within their themes and their regions. But it's not to say that Pan-African businesses aren't being built, particularly in the services sector, where it is possible to operate by satellite or something like that across the continent. There are a number of very good examples already of Cape to Cairo businesses. And I think it's worth just bringing in the service sector into the conversation as well as the manufacturing sector. Our panelists all represent variants of theme of the private equity industry here today. And I speak as a very grey-haired member of that community. When I started, there were probably 10 serious private equity groups in Africa, which would have been 15 years ago. Today, it's well over 200, I think, at the last count, according to the African Venture Capital Association. So I would posit to the panel, it's not shortage of money that's the challenge in development. Is it that, or is it a different challenge? As you're trying to find more deals and more investments of the future, what's the constraints that you face collectively?
Mark, it feels like it's been a while since you've been out fundraising.
This is true. This is true.
I think fundraising in sub-Saharan Africa especially has been challenging. It always has been. And it also depends who you're fundraising from. So if you're fundraising from someone who is a pension fund, for example, sitting in the Midwest in the US, and they can put their dollars anywhere in the world, they need a reason to come to Africa. Because at that point, the perception of risk, the actual performance of the industry, and if you look at the performance of the industry is still relatively young. And so how many funds have been seen through to the end of the fund life? Where have you seen net fund returns? So there's a lot about the model, if we're being honest, that still is yet to be proved. We have great individual stories, and we have great belief as professionals in the industry. However, if you are administering capital on behalf of a pension fund, and you need to think about paying out pensions at a certain point in the future, that risk perception is going to very heavily weigh into your allocation. So there is a fair amount of dry capital on the continent right now. My view is partially because there's a mismatch of the risk appetite. The private equity model is also somewhat flawed in that given the duration of the funds, you are often pushed into the cycle of having to raise one fund after another quite quickly. So you need to start showing exits to start showing enough track record to go out into the market within 2 to 3 years. So as a result, it's the same deals that are being done. It's the same businesses that are moving from private equity firm to private equity firm. And that, frankly, for me, is one of the most worrying things when it comes to private equity on the continent. Because there are very few businesses which are at the top end of the size. So if we really want to grow the private sector, it's the same drum that we've been beating, right? We need to have capital going into earlier stage businesses, into small and medium-sized businesses, and to grow them. But perhaps this calls for a different structure, which is not private equity-like. We've been talking about permanent capital vehicles forever, but it's very hard to raise them because it's tough to raise the capital. And I know that Babak over here has some very strong views I agree with in terms of the role of unlocking local capital on the continent.
You have to build on that point, please.
Yeah, no, thank you, Gita. I think just before I touch on the pension fund, I think what we tend to do in the continent across multiple layers and sectors is, there's a narrative and there's reality. And I think there's a lot of narrative around, there's a lot of dry powder. At DPI, and certainly I know my friends at Helios, we don't feel that way. We feel like there's 11,000 companies today in Africa that have revenues between $20 million to $200 million, right? So there's a lot to do in terms of deployment. The key now is strategy. How are you deploying that capital? I think a lot of us tend to focus on the same things because we want, safe investment, low risk, and all of that. But I think as an industry, as we grow, we need to go deeper and be more entrepreneurial. Certainly at DPI, we're trying to do that, and I know our friends at the various other firms are trying to do that as well. So I think I just want to, put that out there that, there are opportunities. The key is, how you unlock them. And certainly we feel we've deployed 1.1 billion in 10 years. Today we're on the market, and we believe that we can, and within that's 1.1 billion is what DPI manages. Across, if you add the co-investment, we over 2 billion. We've raised 2 billion, another billion in co-investment in the continent. So I think there are no shortage of opportunities, but the key is where you focus. In terms of now unlocking, pension funds and also institutional investors in Africa, I think as an industry we need to do a lot more. Because today, I was just reading an article this morning, there's about 400 billion of pension fund money available. Less than 2% goes into private equity. And I think, if we're going to develop this industry sustainably, we need to find ways to partner with our local institution. Because it's one thing, as Gita mentioned, going to the US, and we do that all the time, to convince investors there to invest, where you have a 2-hour meeting and 1 hour and 50 minutes is spent on telling the Africa story. Whereas when why invest in Africa, correlation, all of that, it's a challenge.
Absolutely.
But we're doing it, as I think a lot of successful firms are doing it. But it's a different story on Thursday when sitting at the African Development Bank, and where the story is, how was your investment in Morocco in education? What are the challenges? What do you need? How can we support? It's a different discussion altogether, and I think unlocking that will help the story a little bit more.
I just want to add maybe one more point, both in terms of the opportunity set, but also the challenges as investors. So I think first is there's a massive scarcity of capital. People say there's a lot of capital, but if I were to ask you this question, is there enough money today addressing the scarcity of power in Africa? You tell me no. Is there enough money today to address the need for affordable education? You'll tell me no. And the list goes on. So the problem is not that there's too much money and not enough opportunities. The challenge is that people are waiting for companies that are readily prepared by Goldman Sachs. They send you offering memorandum and you buy that business. You have to actually, while in our market, you have to think like a business builder and think like an entrepreneur. You have to create the companies yourselves. You can build many companies of scale that are Pan-African. One example is the tower sector, for example, but it applies to a number of sectors. So I think the key one is, it's not like PE like we were doing in the US. It is, you're going to think like an entrepreneur, and you have capital behind you. In developed markets, it is, you're a financial investor. You buy and you sell. In Africa, you build. That's number one. Number two now is, what are the challenges as an investor for us to get good returns? I think first one is, again, you buy businesses, how do you scale companies? One challenge I would say for us is management team and human capital. Can we find a good team that can actually execute? Because again, if you have the hypothesis that the market is supply short, the challenge is actually how do you execute to scale and grow the business? So people. So there are many approaches. Some of us, what we do is we partly insource that challenge by having an operating team of former CEOs, CFOs, Lean Six Sigma experts who can support portfolio companies. That's people, but people is number one for me. Number two is, what is the biggest challenge to our returns? Is currency FX. Ultimately, people want to deliver dollar returns. If you want to deliver a 25% dollar return year on year, but your currency depreciates 10% even year on year, that means that in local currency terms, that's 35%. Some of our markets is 40% depreciation. So how many companies can deliver that return on capital that is far in excess of 30, 40% year on year? That is the challenge. So that means for me, the other challenges are more structural. It is the inflation, it is currency depreciation. So that means the businesses you choose have to have a dollarized business, currency hedge, or the business model. But for us, the challenge is not the opportunities. It is, can you have good management teams with a good business model, and how do you address the FX question?
Building on some of those points, mobilizing capital, mobilizing local capital in particular to move away from the FX risk and some of those points seems to have been a model that, if you look at China, if you look at Latin America in particular, their economic development stories are heavily driven by their own capital formation. So China, and I'm sure there's a lot of experts in the audience, most of that development growth in the last decade and 20 years has been self-funded in China. I spent a lot of time working in Latin America, and the big contrast that always struck me with Africa was the evolution of the pension funds very quickly in markets like Chile and Colombia, and how much they became the infrastructure funders. So each region, each part of the continent has to answer that question one way or the other. And I think the Ethiopian model in particular is an interesting one because you've got a slightly more closed capital structure than some other parts of the continent. There's less international flow into Ethiopia, and it's harder for international capital to buy companies in Ethiopia. How would Ethiopia answer that question today? Where is it going to generate its capital from?
Actually, in the last 4 or 5 years, Ethiopia has been one of the highest recipients of FDI. So that story has progressed in the positive direction. But I think we have actually tried with CFIUS whether to mobilize local capital or not, because within Ethiopia, when somebody has enough excess cash, they don't think about going to investments. And some, like we think about dating, real estate, buildings, homes. I mean, it's all like, it's not in a productive sector of the economy because they don't have the mechanism of actually deploying capital into somebody's business and not get involved. So we found that there's a lot of capital within the country that we could utilize for investments in the country, but the regulation, the tax systems, the accounting status in managing a fund-like structure within the country was not there. And with the capital account controls as well of taking out dollars of Ethiopians from the country.
And are you an optimist that that's going to change? I mean, we've
Absolutely.
talked about government,
Yeah.
private sector
We're in the
collaboration. Is that
Yeah.
is that a
Yeah, actually, we're
story 10 years'
in
time?
the process of reviewing our commercial codes and investment laws. And what they've done is they've distributed the draft to the private sector for comments, which is really great opportunity for all of us to be engaged in. So countries have to evolve and have to, be competitive. We're talking about the free trade agreement, and we can no longer be protectionists of that kind of capital. So very positive about things changing and
Very good.
laws being amended towards that.
And Gito, I know that you're involved in the Botswanan initiatives to mobilise local capital. And perhaps you could just expand a little bit on how the evolved pension fund industry and the government is working with the private sector there.
Would be happy to, but just to piggyback off the point that Berhane just made, she and I met 10 years ago here in London, and she came to talk to me because there was a transaction that she was looking for co-investment on in the cement industry in Ethiopia. And she told me she'd knocked on the doors of my colleagues in Kenya, and they said, sorry, Ethiopia, it's a no-go for us. So back to Hakeem's point from earlier, even within Africa, we need to overcome our own reluctance to go into areas that we wouldn't normally go into. I mean, I became the biggest advocate for investing in Ethiopia within our firm. I opened up that market for us as a firm because my Kenyan colleagues were absolutely convinced that it was not possible to invest in Ethiopia. So I think there's a bit of resistance that we definitely need to overcome ourselves. In the case of Botswana, it's been the other way around. So Botswana is a small country in terms of the population. We're 2.3 million people. But by many yardsticks, it's a very successful country. But it's a country that has not really attracted a lot of private equity investments. I know, Babaka, you've got an investment there. But that one investment has been an investment that a number of, with other co-investors, other private equity firms have invested in. But, we have 16 companies listed on the stock exchange, 6, and one's just about to come off. So the Botswana Public Officers Pension Fund decided that they were going to take matters into their own hands, and they decided to set up to back 2 fund managers, putting $50 million into each one. And the focus of those funds was to only invest in Botswana. There's a grand total of about 5 of us from Botswana with private equity experience. So the pension fund approached us all, and in some way, shape, or form, all of us are involved in those 2 funds. I'm on the investment committee of one of those, Aleo Capital. And this is an example of where a local pension fund said, actually, enough is enough. If we're going to want to see capital being deployed from the alternative side, we're going to have to make these investments ourselves. And usually, the Botswana Public Officers Pension Fund will not write a ticket for less than $100 million into a fund. So they had to make changes internally. And we're in the first year of this, and we're very hopeful that this is going to work out well. And it's allowing these fund managers also to think about what is the next generation for us to expand within SADC. How do we leverage what is happening from a political perspective, where Botswana is trying to become a safe haven in the same way Mauritius has for the fund industry? How can we now leverage the fact that there's finally going to be a bridge built at the Kazangula border between Botswana and Zambia, where before we had a ferry that would go down quite frequently. So, it's about, again, getting public and private to work together.
Thank you. I'd like to hear just the Francophone West African perspective, and then I think we'll throw questions open to the audience for the balance. So, in your region, you've got the integrated free trade area. You've got a common currency. Where is the capital going to come from for future growth, funding infrastructure and things? Is it the sorts of things that Gito has described, or is it a different answer?
I think it's a mix. First, there are good advantages that the West African Francophone region has, and it's through this very stable currency. So today it is pegged to the euro, and the peg has been stable since 1994. And inflation across the region is around 2%. So as a result, you can actually take long-term hard currency capital and make investments in our market. So that's something you could not do in many other countries in Africa because you have 20% depreciation year on year. So because of that stable monetary framework, you have both domestic pools of capital that are available, but also international pools of capital, and you can hedge that currency. So I think that's number one. Now, in terms of domestic sources, a number of the countries are beginning to have their own small sovereign wealth funds, but today the prime focus is in the domestic market. So that's going to change over time. But I think really the biggest asset they have is really that the monetary union and the stability of the currency, and you can look at it as one large market, because you have the OHADA region, so it's under the same law. There's a lot of movement of labor and people across the country. So if you go to University of Dakar, you see people from all over West Africa studying there, and then they return home. So, but I think for us, you do have access to the domestic market as well, because you have the BRVM exchange. Now, the exchange is small and not liquid, but it's a good place to issue debt. So if you have an investment and you raise debt capital, you can securitize debt actually in those markets, which is not the case in many of our other jurisdictions. But now, there's still a lot to do. There's still a lot to do, right? So, but we do have a favorable framework, though.
Very good. Anything to add to that, though?
Yeah, I mean, the only thing to add there, I think, maybe just focus a bit on the challenges, because Soleil did a good job on the benefit. The challenges are, the regulation. So if you look at, it takes a while we tried IPOing a company to exit through that market, and it takes 18 months just to get your paperwork ready. So there's a lot of bureaucracy. They need to streamline.
The ease of doing business.
The ease of doing business need to be improved. But as a market, I totally agree. It's 100 million people, same common law, same currency, easy, and people there's a lot of movement between the countries. So finding talent also is relatively easy. But the key is unlocking, working with government. I think the key here, I think, Akim touched on it, is how government now and business can sit together and come up with a plan that makes sense to develop some of this area that needs money.
Fantastic. Yeah. I think that's a very good place to pause. So there you have it. That's the practitioner's view of deploying capital. Let's take some questions from the audience. I don't know where the cube is, but...
Get this. Hi, my name is Samuel. In regards to capital, education, all these things are really in GDP. My question is, do you think there's any sort of possibility of reinventing GDP from Africa that creates a new narrative for the rest of the world? That's my question. Simple.
Any volunteers on that one?
I'd love to actually pick that up.
Okay. Yes.
And this is off of the keynote that was given by Arun Maute yesterday. Why don't we start with unlocking the power of women? Over 80% of the consumption choices is in the hands of women on the continent today. Yesterday, the IFC released a report which looked at gender within the private equity industry. And what they found is not what you see here. So what they found is actually only 11% of us in emerging markets private equity in senior management are female. But where there was more gender balance, the returns from the investments were higher by 20% on a net IRR basis. 20%. So I think one thing that we can really do is, if you want to change the GDP narrative in Africa, is let's engage the women. And I think Berhane is a fantastic example of someone who's already doing that.
Thank you. A very interesting perspective. I'm going to keep going. So the lady in the third row.
Hi, yes. So I'm from Botswana. My name is Thokozile Tembo, and I'm from Botswana and Zambia. And I'm interested to know what you think would be the best opportunities for investment in terms of the sectors of emerging markets like Botswana and Zambia. What sectors would be ideal for investment, especially given the fact that a country like Botswana has such a small market, and how do you get around being able to leverage those markets? I don't know if that makes sense.
I think that one's one.
Yeah.
You know, the theme of the conference today has been about the Africa Continental Free Trade Agreement. Currently, 18% of exports of African countries is traded within Africa, 1/8. And the equivalent within Europe is 69%. The equivalent within Asia is 59%. 70% of our exports as African countries is actually in commodities. So there's a piece here that we haven't quite touched on, which is the correlation of opening up trade and the necessity of building up industrialization. Now, if you look at Botswana, we were able to get the diamond cutting center back from London to Gaborone. So what else can we do to actually retain? We're going back to an argument and a discussion we've been having for 20 years, which is how do we retain more of the value chain on the continent? I think that in combination with the opening up of the markets is what's going to yield even more opportunities. If you think about the beef industry in Botswana, which is exporting to Europe, and then next door you have beef which is being imported from New Zealand. So with your coffee, it's the same thing with your coffee.
The beans and other African countries import the roasted coffee. So
So therein lie the opportunities, and you know, to Sulei's point as well, it's about being a builder. And for many of us, we get approached a lot by young people who are interested in going into the private equity industry. And for me, I think what is far more interesting and sexier is actually being the entrepreneur, building those businesses.
I'm going to keep moving. Gentleman with the blue box.
Oh, hi there. My name is Winston. I do project finance projects around the world. And my question, I guess, to the panel is about your sources of funding. At the beginning of my career, I did a lot of work with the European Bank for Reconstruction and Development. So a lot of the funding there was always backstopped by export credit agencies and development finance institutions. In the Middle East, it was backstopped again by organizations like the Islamic Development Bank, which happens to have quite a lot of members who are from Africa. And I just wondered whether there were any structures in Helios or DPI or LGT which sort of think about maybe blending some of your funding sources from not just being backstopped against Goldman Sachs, but maybe, you know, the Islamic Development Bank, who maybe with their Sharia compliant or Sharia principles may have the sort of patience just naturally that maybe some of the Western organizations may not always have because of the way they're structured.
So DFI is part of your funding sources?
So I'll actually funding source from 2 points of view, both from the fund itself and then from the point of view of the companies we invest in. So from the funds itself, for Helios, for example, our first fund came through the support of DFIs, right, from the IFC, OPIC, and other institutions. Over time, as we went to our third fund, it became around 95% came from private capital, meaning pension funds and institutions. That being said, in our investment, we still do collaborate with many DFIs, but it always starts with what's our investment thesis, what are we trying to create, and then what parts do we need to bring to the table, right? So if we're going to do something in agribusiness, maybe it's going to be the FDB, or it could be something in Europe because they have some expertise, they have technical assistance, and they may have the right type of funding for that business. So for our view is always start with the business first. But now in terms of the capital structure for our companies, that is actually the case. When I think about our investment in the tower sector, some comes from bank funding, some comes from bond funding, but part of the funding comes also from development organizations. For do I have a mandate might be in access to information, might be their mandate is focusing on access to renewable energy, and what we do is we get that funding to invest in solar panels, and hybrid batteries, so you don't use diesel generators to kind of help the environment. So there are many ways actually we do partner with institutions, and it doesn't even stop there because there was this question about China earlier. Quite often many of our companies would import raw materials from China, transform it, and sell to the local market. So you start building strategic partnerships with actually the suppliers of the chain, and you work through export credit and financing to finance your working capital. So there are actually a number of creative ways where you can finance the businesses themselves, but also finance your fund itself.
Thank you.
Do your funders give you enough time to play with the Rubik's Cube, if you want, in terms of there are some situations which just have to play out over time. If you're on like 5-year money or 7-year money.
Yes. That is correct. On the equity capital side, both on debt and equity, I would say, on the equity, generally it's like a 10-year life, right? So 10 plus 1 plus 1 up to 12 years. On the debt, you do have a constraint on tenor. Now, the constraint on tenor really comes from the underlying, I would say, currency volatility. If you are in the CFA zone, you can have a long-dated tenor that's even hedged by OPIC for 30 years. If I go to Nigeria, when you have inflation at those rates and treasuries are in the double digit, if you compound it over 10 years, you're never going to pay it back. So there are some structural challenges you have on the funding structure, but you do have partners who are willing to work with you.
I'm going to try and push in a couple more questions. We've only got 5 minutes left. I think there's some questions about the gentleman in the blue shirt with a hand up there.
Question to the panel is impact a core part of the investment thesis, and how much effort and time and resource do you put to measure and manage to it?
Can we have a quick, very short answer to that one?
Sorry. For us, we have a dedicated team that does the measurement. Impact is in every investment that we make. So the challenge is not finding where we make impact. It's really making the time and investment to measure it and report it. So we do have a separate team that's dedicated to impact measurement.
So very similar. I think my view on impact, so we all collectively, I think, do a lot of things on impact because of the DFI backing. So, a lot of us have DFI money. I think where the key is now agreeing on what's impact and how to measure it. And I think that's where we need to collectively, think about how to best effectively do it. But impact is key. I think when you're building a business in Africa, you're doing impact.
I think it's a license to do business, frankly, for all people in the industry. And all of the private equity industry is committed, I think, these days. Question right at the very back. Yes. So.
Here? Oh, okay.
Yeah.
Hi. I'm Nick. I'm a Kenyan, South African. I come from a strategy consulting background. So KKR recently closed one of their largest Africa-focused funds, citing that they don't have companies large enough to invest in. Do you guys struggle with that? And do you think that, this kind of idea of Western management philosophy has to change when coming to Africa from not just a strategy consulting standpoint, but from an investment standpoint also? And what are you guys doing around that? So if KKR, with all of their money, can't find big enough deals, is that a function of the way KKR sees deals? And would they have to change their perspective on that?
Yeah.
Thank you.
I'll maybe briefly touch on that point, which is that, and I think it touched, which is maybe the way they approach deals has to be different in Africa, right? Again, it's not a market where you go in. So I would compare, in the US, you go to a supermarket and say, what's on sale? In Africa, you go to a farm, there's a field full of diamonds, but you have to do the work. So the key is you got to figure out what are the opportunities and can I build a business of scale? So it's about building businesses and helping them scale. When you look at our portfolio, if you run a screen anywhere on Bloomberg or any data, most of these companies, you looked at them 5 years ago or 10 years ago, did not exist. And they're all multi-$100 million businesses today. Why? It's either you built those businesses or they are non-core businesses for multinationals. Senegal in itself is a small country in itself. But if you look at the entire region, what you'll see is there are a number of businesses that have a presence across West Africa. And when you aggregate that business and you create a standalone company, it's a sizable platform. So the key is not about, again, going to the supermarket and saying what's for sale. It's about what is a large unmet need that is modular and scalable. I can have a good return on capital, and I have a team behind it. And for those opportunities, actually, it is vast. But you have to be an entrepreneur, and you have to be very creative.
Thanks, Uli. I'm going to try and get one last question right at the back at the left corner there. We'll try for two if we're quick. I'll try to go around the floor here.
Okay. My question is for the idea of a single market, global outcomes as we're talking, and the sort of disparate perspectives. On the one hand, West Africa and a rather unified region, and on the other hand, Botswana and Ethiopia, of, dare I say, a single African currency, or if considering in another single market we might be familiar with, this poses more challenges than opportunities for investing.
I think as you touched on, using the EU as an euro as an example, I think a single currency is the final step. Once you have free movement of capital, labor, and you've got to be able to have a consolidated fiscal policy. Yep. Here's the challenge you have. Let's just look at West Africa. Nigeria's GDP is 15 times that of Senegal, and a big part of it comes from oil. If you integrate Nigeria with the Francophone zone, with just the movement in oil prices and the change in oil production, it has a cascading effect across the entire region.
So not this decade, I think.
Not this decade. And if they do it, it will be a mistake.
Which I'm afraid is the note we're going to have to.
If I could just add one thing here. The point of a single currency is what is the utility of a single currency? And can we get to it without having to fight over whose face is going to appear on the note? So why don't we talk about actually what is happening in terms of blockchain? Why don't we talk about what has been happening with Equity Bank and the use of mobile communications and what that unlocks from a financial services perspective? So I think for me, it's less about a single currency and more about how can we get financial inclusion in a very, very different way.
Thank you. I'm afraid we're going to have to draw a line there. I'm very conscious there's a large number of questions in the audience. The panelists will be around. And let me just finish by saying thank you for a tour de force tour of the continent and capital markets. So thank you, everyone.